Okay, welcome to the next episode of the Investment Club. So on this, for this in the very beginning here, I'll just talk about looking to use the Webull platform to buy security shares of stock or ETFs, whichever you want to buy something. That's sort of the point here. So, so to go over this, if you open up on your laptop, desktop, whatever, you'll see if you go to you start here on the left side. You can also do trade, but I prefer just clicking on stocks on the left hand side there, clicking on that, and then it'll show you a particular stock or whatever you want to do. And then you can look to this, and on the right hand side, and you can search as well to be able to look for one in the first place. So after clicking on that, you want to look for something, you want to look for SPY, whichever. You go here, and in fact, actually, I can show you what that would look like. Just SPY, put that in this the ETF for the SP 500, and so now you've clicked it up, and there's various things that you can look to that would mean something. As I say, there's margin, there's shorting, that sort of thing, but that's sort of outside of what we're looking at. So try to put this into a nutshell, just really simply. If you want to buy, for me, because I have an account that's set up for shorting, there's this third button here. But when you look at this though, you're only going to see the buy and sell. So you can click buy, and if this is during market hours, you can click on market, and there's the number of shares. There's also percent of your money that you have. Let's say you have $100, you put in 10% of your account, right, $10 into buying this. And on the desktop, they don't have fractional shares enabled, but they do have that for the app. And then they have the dollar amount here, that sort of thing.
Why would you want a fractional share?
Fractional shares just because let's look at Amazon, right? It's thousands of dollars, and there's even one for Berkshire, Hathaway, and it's worth $400,000 or something like that. So,
for one share.
Yeah, they do that sometimes. So yeah, it's crazy. Yeah, I know. So obviously if you want to still have a part of that, but you don't have the money,
yeah,
fractional shares. So yeah. Anyway, so clicking on market order here, and let's just say you just want to go with the shares here, and you just want the one, and you give it the market. Now the market on our side of the country, on the West Coast, the market is open from 6:30 to 1 p.m. 6:30 a.m. to 1 p.m. And so while the market is actually open during those hours, you can click on market. Now outside of that, you'd have to do with a limit. And the extended hours, you'd say the pre-market and after hours, the pre-market starts at 1 a.m. and goes till 6:30, and the after hours goes from 1 p.m. to, I believe, 5:30. I believe it does. I believe it is 5:30. Yeah, that sounds right. Anyways, yeah. Anyways, though, you'd have to do a limit order. But let's just focus right now on the market. So now you've done, it's during the market hours. You clicked on market, buy. Here's the quantity I want to get. Here's one share, and then time in force. So the day. Now they have it like that for here, and I think I've seen variations on this before. But regardless, a market order. Usually, to talk about the nature of these things, if you're looking at a market order, and we'll get into limit order as the opposition to that. There's other ones, but we won't talk about those. So a market order is usually I want my shares now, as soon as possible, whatever I can get it for, sort of thing. The time in force day is just that I will have this order out there for the day as for whatever day it is right now. So for example, today, let's say the market is not open anymore, but let's say it was an hour in the past, right? It's 12:30 right now. I do a market order. The time in force here is only available for the day. That means that as soon as it turns 1 p.m., this order is no longer there. It's gone. That's how that one would work. Then there's good till canceled, and that has to do with limit, and we'll get into that once we do. But outside of that, though, and again, there's stop loss, take profit. Don't worry about those. Doesn't really matter. And so if it were 12:30, right, if the market was open right now, I would click place order. It says this right now. But then, it'd say all right, just go ahead and confirm, and then, there it is, and you get that. So now here's the other one. there's limits, there's limit buys. So a limit is just talking about like a specific price. So let's say that, you know, right now, and something of a, I don't know if you want to say it's so much of a hack, but something to at least point out is that there's these two things up here called a bid and an ask. And the bid is just talking about what people are saying, like, I will put down this much money to buy the share, and the ask is saying, in order to sell this, I want this much money, that sort of thing. You can look at the difference between these two, and there will be a difference between what numbers are up here and what number is actually like here, because this is sort of like the averaging between these sorts of things. So if you want to do a limit or something like that, you can look to like what the bid is doing, and you know the difference here is only like by 8 cents right now. It's also after hours, so that's why it's fluctuating. But let's say it was just 401.50 cents. You can go like, all right, well, I'll go ahead and just be able to make sure that I get my order filled. I'll do 401.55 cents, you know, that sort of thing. So you can put in that limit price here, 401.55 cents. I only want 1 share. The time in force here is day and good till canceled. Now, for the limit, the day would include, if you were to say yes to the extended hours, the day would include whatever market hours, you know, that, let's say again, it's 12:30, no longer 1:30, but let's say it's 12:30. You do day, the market order would end at 1, but if you say yes to the extended hours, which is talking about the pre-market and after hours, then the day would last until the end of the after hours. That's how that would work. If I say no to that, then it ends at 1 p.m., you know. And then, if I don't want good till if I don't want, you know, day order where it's like it ends today, right? I want good till cancel. That's what GTC stands for, right? It's an abbreviation for good till canceled. What that means is that your order stays open until you cancel it. You can go out weeks, you can go out months, years, it doesn't matter. It will stay on the books indefinitely. I think it might actually end after some period of years into the future, but you know, effectively, right? It stays open. And of course, for this, if it's yes to the extended hours, then it will stay open and be able to be filled during all those, you know, pre-market and after hours, you know, that sort of thing. But that's really it. And you can look to your account page, and you can see, and we'll you know, so you know, there it is, place order, and you know, same thing. And then if you did want to cancel this, you can go into let's go here. I want to go into my account. What it will show is if you want to go into, I don't know why it's like, oh, okay, there it is. Anyways, if you want to go into today's orders, I believe it should be there. Yeah, it would be. Yeah. Anyways, so just click on today's orders, and then you'll see something open here, and then you can click on that. I think it's like a left hand, or sorry, rather a right hand click on the mouse there, and you know. So for example, I might actually be able to do a demonstration here. If I wanted to do here, let's do SPY. Let's do a limit price of, I don't know, $300. And I want to say until canceled and extended hours. Yes, place order. Yes, continue. I want to buy it for $300. It won't let me, obviously. That is like, you know, and that's what it looks like, right? It's all the way down here. That's not going to happen, but
Maybe one day.
yeah. But the point is, and there it is, today's orders, and I right-hand click on it, and it can say modify if I want to, you know, change things, right, in its nature, or cancel order. I'm going to go ahead and cancel it.
Whoa.
Oh, it just went off. Oh, no, there it is. All right.
Weird.
Did it show me like clicking cancel order? It said it showed that.
I
It
think
did.
it
It totally would. Anyways, okay, so there's that part. And I think that's really all I would want to show through you guys as far as buying these things. And so now into specifically what we're talking about for the crash that's going on. So IO, we've gone over in the past why the market is currently crashing and how it maps on pretty accurately to history, and to the extent of where at certain points, at certain significant points, it goes to the exact day sort of thing you know, as far as what's done in history. But we also know why the market would be crashing in a general sense.
So it estimates before it happens, you're saying, or am I tripping? Like, I'm not.
What?
Oh, that's.
Right, it's like it's my same ring job. So the point that I'm just trying to say is just that you can look to, so here's a number of things of why, in fact I actually kind of have a short, you and I will go over this, but to give a few examples, the valuations, we are in the largest stock market bubble that has ever existed, larger than 1929, larger than the dot-com bubble, which was, the dot-com bubble happened in the year 2000. It was the one that was bigger than 1929. We're in the one that's bigger than that one. And then you can look at a bunch of different other things to show that the market is in a horribly weak place. The worst technicals that have existed for decades, between the bonds and the dollar, showing that a lot of hedging, and then also hedging and then exiting out of the market with the bonds. We've had a yield inversion that's shown that has been a precursor to every single recession since 1958. Yeah.
I thought there was like one that it...
With one exception, it was a false alarm. Yeah.
Right.
Yeah. Yep. Might have even predicted the one before COVID, which is funny as hell.
Wow.
Yeah, because it's like, and it's not so weird when you think about it as sort of like a signaling, because this is sort of like, if you look at the stock market, it's social media. Absolutely, it functions in the same sort of way, at least in the sense that there's this mass communication going on. There's all these people looking at it, trying to understand it, and there is communication going on a massive, a lot of money sort of level. If you look at a lot of these sort of leveraged ETFs, which they're significant, namely because the earliest one goes all the way back to the very bottoming of the great financial crisis. Those things happened. The ones that are pro anyways, we're looking at inverses, which just that they do the opposite of what the market does. So when the market goes down, these go up, that sort of thing. Anyways, so the ones that are pro, the first one though, and there's a whole bunch of them, but they all started at the very bottoming of the great financial crisis in 2009. And there's a couple of them that I think actually Hibbs, funny enough, which is the one that we're looking at, started November of 2019. That was the very first messages or signals that we started getting about that COVID was even a thing.
Yeah.
It started then, which is freaking funny. Anyways, though, and as far as like the pros, it's like the timing of all of it to be like here now at the very bottoming of this market crash that just happened, we're gonna have this amazing bull run that'll be worthwhile, sort of thing. Just funny timing of all. Just sort of the theme. Okay. So let's see here. I'll go over this first. So let's go ahead and look at this slide.
And this is a world market or just the United States market, or I don't know how any of this works. I'm sorry.
No, don't worry about it. So there's the New York Stock Exchange,
okay,
which lists a bunch of different companies, and then there's the Nasdaq, which is listed on the New York Stock Exchange. Then there's also the S&P 500, which is listed on the Nasdaq 5. It's a part of the New York Stock Exchange, right? You can go there in person and you can trade on these sort of things. And then there's a different stock exchange you have in Hong Kong, and they list different companies. You know, the S&P 500, and as an ETF may be over there, but the companies, a lot of them won't be listed on that because that is Chinese focused. We're talking about American companies here. But on Webull though, you can trade companies though that are from all around the world though. You can trade Russian companies, Russian ETFs and shit like that.
Is it all in US dollars?
I think so.
I figure the Chinese one's probably.
Yeah, I don't. You'd have to. You might be able to, you could go to like Fidelity because that's definitely a much more I think global sort of thing. You can go to them and be like, I have these wands, these Chinese wands, and I want to be able to trade them in for dollars, and they'll be like, all right, we can do maybe an exchange here going on, with things. But you'd have to ask Fidelity about that. For this though, no, I don't think they trade in wands. I think it's all American dollars. Yeah, pretty sure. You might be able to show it in something else. Like here's like the language. Anyways, nothing really to worry about. Huh?
Does the main part of China use the same currency as Hong Kong? Because I know Hong Kong it's within China. It's like a one China thing, but they are more. Yeah, exactly.
It's in between. They're a hybrid.
Do they use the same yuan or yuan? I guess Korean's yuan and Chinese is yuan or yuan. I can't pronounce it. With Y and V W.
Yeah. I believe it's the Chinese yuan.
Okay.
Trying to think. And I mean, as far as Hong Kong, I think so as well. Like probably just to be able to at least have like engage in trade.
Yeah, that's what I was thinking because they're right there and they're part of it. Yeah. Okay.
Yeah. and then for the, I'm thinking about the Japanese one now. God, do you know what the dollar is for the Jap?
Yeah, like the amount or what it's called?
Yeah, what is it called?
Yen. Y-E-N.
The yen?
Yeah.
That's right, it is.
And
You got that.
Korean is W-O-N, won, and both Korea, North and South, use different types of won, but they both use won.
Interesting.
Yeah.
Anyways, okay, so, trying to think about weeks here. So, when we look back at for the S&P 500, anyways, the last largest bubble that had ever existed was the dot-com crash. When that happened, the S&P 500 in its full bull run, so to speak, you know, just to give some ideas here, and I'll also refer to Jeremy Grantham, who has over half a century of investing, and he's the one who inspired Warren Buffett in his style and all that sort of stuff. He says that conservatively speaking, we would be entering into a crash of like 50%. Looking back on history to give us a sense about like what we might be able to look towards. The S&P 500 for the dot-com crash, which is the most similar bubble that we're here now, because the dot-com crash was a tech-focused bubble. We're in the same sort of thing. It's also called the everything bubble because real estate is roped in, because crypto is roped in, because NFTs and shit like that. But yeah, it's a pretty wild bubble. Anyway, so the S&P 500 during the dot-com crash gave up roughly about 2/3 of its bull run, right? Its full bull run when it really started taking off in like an obvious sense. Here now we can look back to the very bottoming of the Great Financial Crisis, and we can see that's what it looked like, by the way, the dot-com crash right here. Here's the S&P 500, which was also like in bubble territory, but it wasn't in like a super bubble like the S&P 500 was. Now, mind you, it might not look like that different, but let's look at the NASDAQ, right? What did the NASDAQ look like? It looked like that. So when we look at the stock market, right, it was like, you know, it was in a really tech-focused bubble. Same sort of thing. In fact, actually, it's funny because you can look at sort of like what it looks like. Well, I'll leave that alone. But anyways, so it gave about 2/3 of its bull run. So we go back to all the way back here. We've had this massively like historically anomalous. Can't say that. You know what I'm trying to say though. It is an anomaly, right? All the way back here, right, since the very bottoming of the Great Financial Crisis, and we've just had this massive ass bull run. So we look back on this. And we say, okay, here's this bull run mathematically, and we say, let's strip away 2/3 of this. Let's say that we give up 2/3 of this bull run. We will end between, I believe, actually at about a 60% decline, right? Jeremy Grantham, right, who inspired Warren Buffett, who knows of like valuations. I could show you what it looks like. I've already gone over it. Well, you know, I'll show you, but we are just hands down like head and shoulders above by at least the Warren Buffett measurement indicator that he uses. We are head and shoulders above any sort of bubble that we've been in before. So if 50% is conservative, then 60% is very well possible. But the point about this I would just make is that once we get to this sort of level, at 50%, at 55% down of a crash out of the market, you can start over the next like few months. And we'll also talk about a timeline. I've talked about that before. Historically, the dot-com crash went on for 2 years and 7 months to the day. So you can look to that as also sort of a sense about like, they're supposed to like work together, so to speak. So let's put it like this: if it's been like a year and a half, but the market is down by 60% or 55%, right? We know that it's only going to, realistically, unless something terrible happens, COVID comes up again, we get turn into a world war, right? That realistically speaking, that this is probably about where it's going to go. At this sort of point, you can start pulling out, right? If it goes for 2 years and 7 months, right, to the middle of 2024 is what it comes out to, just about. Anyways, middle of 2024, we get there and it's only declined by 45%. You know, to start pulling out, that sort of thing. Anyways, though,
What do you mean when you say pulling out?
Start selling. Start selling, yeah.
I don't want to sell when it's hot.
Yes. So if you had shares of the SPY, you'd probably be wanting to sell right now over the next couple of weeks, right? And we'll talk about that as well. And the transition from that, anyways, I was just thinking about Forrest, might be coming back later. Anyways, the transition from there that we would make is into the inverse leverage ETFs, which go up because the market is going down.
Okay.
And the ideas that we have for that are HIBs. Here's this one. I looked at hundreds of leveraged ETFs, both pro and inverse, and the best ones that came out were HIBs in particular, which based off the S&P 500. And so not only just like how much this goes up when things go down, but as well in terms of like the security we can have to, I can look to something and know that I have that as a reference point for when I should be starting to sell out of HIBs, right?
So the inverse is like when it's a bull market, you want the pro.
Yes,
and
absolutely.
when it's a bear market, you want the inverse.
Yeah, and we can look at these pro. We'll talk about this more in the future, but we can look at these pro 3 times. For example, like I believe SOXL. It's crazy actually. If you look at retail, this thing
Whoa.
nuts. Yeah, it went from $1.50 all the way up to about you know, if you want to say it like that, $50 or something like that. You know, honestly, when I higher, 55. Went up like 3,000%. And now it's down to 12. This is sort of what I'm talking about when we talk about the crash that is going on. And you can look to, and even though this is leverage to these sorts of things for retail are more exaggerated, so to speak, but you can look to so many different other things and see that a crash really is going on. We see that when we look at market breadth. And I believe, oh God, did I go over that last time or was that the time before, Laura? Do you remember? With market breadth, where it's like look at the percent of stocks above or below their 200-day moving average.
We were definitely talking about that a little bit last week.
Yeah.
But it definitely like it's come up before.
Let me go ahead and show you really quickly if I can. I'll go to Trading View.
We were at least trying to look at the market breadth, and then the camera screwed up.
Yeah. And this is another one of the major reasons why we understand the market is in a horrible place in terms of its health and very likely to crash. It is crashing, really, I should say. Let's see here. There it is. Okay. Let's go to. Here. Huh. So I don't know technical difficulties. That's kind of
If
weird.
we're out in 2023, what the?
Yeah.
How was that?
Here. Just because I think it's important to see this, but here. Oh, okay, maybe it's this one.
I don't think we've gotten this part on camera yet.
Yeah. Oh, jeez. Sorry, guys.
This is great because I feel like I'm getting into the flow of it. So you know how like a dry sponge does like if you put water on a dry sponge, like it'll just kind of roll off at first. Like that's like exactly how I was showing up here. And now I'm a little bit saturated, and I can start settling it up.
There. All right. Now, okay. So when we look through history, generally, what happens when we see a decline? So if we look back to, I'm trying to think about a good example here. It's a little hard to like look at this and then look back on this. But here, maybe this is like yeah. So what happened here was that we had like a bull, sorry, not a bull market, a bear market, which is the opposite of a bull market, right? Things are going down, and the market declined, I think, somewhere between 16 and 20%. I think it was something like that. Point is though, is that when we look at, okay, so this also references Dow theory. It looks at how do we understand what is this stock or what is the stock market doing, right? We see its trends. So the positive version of Dow theory is that there are higher highs and higher lows. We see this going up, right? And the negative version is the opposite, where we see lower lows and lower highs. Thing is trending down. So when we look at something like the percent of stocks that are above the 200-day moving average, and we see a decline here, right? This is showing a weakness in the stock market, even though we might look at the SPY and say, oh, but everything's fine, right? But what this shows us, it helps us to see a weakness, a structural weakness in the market, right? And this can lead to some pretty significant declines. When we look at where we are now, right? Just keeping sort of in mind this area right here, right? Because this led to a crash right down here. This sort of, you see this decline that's going on. Here's where we are now. This is us. This is us. And I see this with so many different things since about April, maybe even earlier. But about this area though, something really changed. And we see this exactly as well. This sort of topping and significant decline. Like that is historically really freaking weird, right? That really stands out when you look back on history, and I have. But something changed back here, and this exactly maps on as well when the bonds started hedging against the market, when the dollar started hedging against the market, when these things were going up, showing that people are insecure about their, with the feelings of how the market is going, the security that we can have with putting our money into the market. They instead put their money towards, the dollar and bonds. Anyways, that's just how that one works. But just to show you what that looks like, significant structural, lack of security, right, in the stock market. Significant structural damage is being done. There's that. Also, to note, we had inflation data come out, and it wasn't good. We've been looking at, in the past meetings here, we've been looking at where the market has been. If you look at, okay, so bit of context. When you look back on, so several times over, when you look back on the Great Financial Crisis, when you look back on the dot-com crash, the two last largest crashes that have happened, and you look through all the different indices, you see several times over, for all these, the same sort of very obvious pattern arise, through all these things immediately after they've come down from their heights. So to show you what I mean by this when I say obvious, let's look at the IWM, because this makes it really obvious. Also, by the way, fun fact, historically, small caps, which is the IWM, it talks about smaller companies, it has led the large caps. In other words, that when we start seeing problems for the small caps, that's going to foretell future problems for the larger caps. So,
is small caps like kind of smaller companies?
Yes, that's exactly what that means.
What is caps?
Caps is talking about market capitalization.
Oh, okay.
Right. Yeah. That's just what that stands for. It's just like, what is the valuation of this company? So, for example, Apple has an extremely high valuation, and so its market capitalization is also extremely high. So what has also happened historically is that you see these honestly, this is actually as long as it has ever been. So really, again, like just so stupidly obvious here that we are actually definitely crashing. But when you look back on history, you can see periods of consolidation, this sort of back and forth, where it's sort of like the neutral version of the Dow theory, right? It's not going down or up, it's just going sideways. You see this for the market tops back here. And then what happens when they crash down and crack down below, what happens is, again, you can look back on this and it's very obvious. Imagine effectively an M. It has 3 humps. That's what that looks like. It's happened several times over and over throughout the last 2 different crashes. These things happen, these sorts of patterns happen. It's a recycling of strategies, and they do this because it works. And now we are crashing out of this. So let's look back on, okay. Yeah, the inflation data. So yeah, okay. So the point that I was trying to make about this is just that. So I'll give you the inflation data first. The core CPI, which is really what the Federal Reserve looks to. So okay, also in context, the Federal Reserve is a private bank. It works with our country though in printing our money, and it lends us our own money to us at interest rates. When their interest rates go up, it will cause other loans like mortgage loans, right, house loans, and car loans and other things, right, business loans. Their interest rates go up as well, right? Because the money is being passed to them. It's sort of like if my cost as a producer, and this is something else that we look at, this the producer price index. Anyway, so if my cost as a producer to be able to get the raw materials and construct things, whatever, right? If my costs go up and I sell it to you, this store like Walmart that takes these items from other manufacturers and brings them into their stores to be able to sell them to consumers like us, right? Their costs go up, my costs go up, right? As a producer, the cost that Walmart will pass down to us will also go up, right? Their prices for their items go up. That's how that works. Anyways.
Walmart will probably just drop you for another cheaper product.
Anyway, so when we look at also another part of the context here is that the reason why we've had this bull run instead of crashing when COVID struck was because the Federal Reserve came out and they put their interest rates to 0. This allowed more money to be gotten more easily, and has caused, just because this is just what happens, the nature of all of it, it goes into the markets. When money is easier to get your hands on, you put into the markets to be able to make more money, more, that sort of thing. Biggering and biggering. The Federal Reserve has now come out seeing inflation, which is exactly a natural, you want to say, reaction to these lowered rates. That if money is easier to get your hands on, the cost of goods go up. Just because there's more money in circulation. I think something like, since COVID, of all money that has ever been printed, 40% of it was since COVID, something like that. Yeah. And so the natural reaction, you get into economic theory, but the natural reaction is just that inflation happens.
Wait, I'm like...
Yeah, no, I know. Economics is weird. You get into it, it's a weird science because you're also doing like psychology and numbers at the same time, and that's just like weird. But as far as my understanding is concerned of it, is that the basic understanding is that if people can get more money, their hands on more money, that means that those who are able to charge others want more of that more money. Does that make sense? Okay, yeah. Just because they can is sort of the point. That's basically it. Anyways. So the Federal Reserve looks to core CPI, which excludes food and energy, and they look at the rising cost of things. We had inflation data come out on Wednesday. The expectation was for month over month, which was just since last month, never mind. I was thinking about something else. That was year. Anyways, so for month over month core CPI data, we had an expectation of 0.4%. This was done by surveying. We had an expectation of 0.4%. Month over month rise, we had a 0.6. That is a beat by a factor of 1.5, 50% beat. That's really high. That's not good. We have been seeing through this market, and it's funny because you can kind of see it happen. But what we've been seeing through this market is that market makers, they have a lot of money. They control markets and what happens. This is a sort of almost common knowledge, really. Algorithms control a lot of it, but of course the people who are the biggest players, But anyways, what's been happening is the exact same thing. They are recycling strategies again because they work. And so we've seen to the exact day the markets mapping onto what happened during the NASDAQ, during the .com crash, which is of course no surprise anyways because the NASDAQ crashed the hardest. It was the tech-focused bubble, which is exactly what we're in now, and we're the largest bubble that has ever existed. So it's gone to the exact day and it's recycled pattern. Unfortunately, the data here of the CPI, the inflation, has come out 2 days ago and seemingly has not allowed for the narrative to continue. Instead, we're seeing something different happen. And this also goes back to other strategies that they've recycled to the exact day, again, as a theme, and showing us, our eyes back to what happened for the NASDAQ during the Great Financial Crisis, where what we saw, and I can show you this, let's just do that. Where what we saw, and I can show you this, where what we saw was, actually, I'm sorry. No, that's what I was thinking of. It was a SPY. I got them confused. It was a SPY during the Great Financial Crisis, where we saw what happened. Whoops. Look like this. So they've done this before, where and it actually was from the SP 500 as well, looking at a bottoming that was in place. But anyway, so the point about it is that you can see these sort of things line up. Now this is more elongated. We're doing these things sort of quicker, but you can see we crash down below we say these are like support lines, so to speak, and resistance lines. This is how we see trends in stocks as part of technical analysis. And we can see support here for the first segment, again, of the three segmented parts that we looked through history. This sort of humping, right? It's maybe like a little weird here, but this sort of humping between this and this part and this, right? That happens time and time again, several times. So the two last crashes have happened. It's just real obvious. Again, I wish I could show you, but it, it'd take too long. But you and I can look at